Awesome. So thank you so much, everybody, for joining us today for our Tenant Talk live session. Again, as a reminder, this session will be recorded and posted on our YouTube page after this call, and we'll send notes and links and everything in our follow-up email as well. And thank you, everyone, for joining us today. I appreciate you all giving me some grace last month when my puppy got sick, but she's doing a lot better now, and she's actually playing right now. So if you hear anything, that's probably going to be what's happening in the background. Today, we're going to be focusing on the HUD's moving to work demonstration and what it is, including the structure of the cohorts, but mostly we're here to really talk about your feedback and what you all want from a future cohort to focus on. And we'll be joined by experts to provide more context on what the moving to work demonstration is, if you don't already know what it is, as well as explain the idea of proposing credit and asset building as a new topic for the newest moving to work cohort to focus on. So before I invite any of our experts to join us, I do want to provide some brief updates, including legislative updates and emergency rental assistant updates, since we won't be joined by our NLIHC staff today. A reminder that I'm not an expert on these topics, but I will be just providing a brief update. If you have any questions in terms of the legislative update, you can always email Kim Johnson at kjohnson@nlihc.org. And for ERA questions, you can always email Emma Foley, or you can ask me too, since she's joining us today as well. Emma's email will be efoley@nlihc.org. And I see that Kim just dropped her email address in the chat. So getting started with our legislative update really quickly. As I'm sure some of you may know, we have been waiting for the Build Back Better Act to pass for a long time now. And I firstly want to thank you all for the strong activism that you've been doing over the last year. Without you all, without your continued advocacy, we honestly could not we could have not passed what we have passed in the past, and we are hoping to continue pressuring Congress to act to make sure that these historic housing investments pass. And so currently right now, we know that the House of Representatives passed a 1.75 trillion bill on November 19th, which was almost a month ago. And so this contained 150 billion in affordable housing and community development investments. And this includes significant funding towards the House campaign's top priorities. So it includes 25 billion to expand housing vouchers to an estimated 300,000 households, 65 billion to preserve the nation's deteriorating public housing stock, and 15 billion for the National Housing Trust Fund to build and preserve over 150 affordable, accessible homes for the households with the lowest income. So the House vote was obviously a really important step, but the fight for the bill getting enacted is not over. Right now, the act is currently sitting in the Senate, and it is going through negotiations with Senate members, as well as going through just like a look through by the Senate parliamentarian as well. So they're looking to reach an agreement and a final size and scope of the bill, hopefully before the holiday break. We were hoping that it was going to happen sometime next week, but now we're also hearing reports about it happening the week of the 20th. So our goal really here is to make sure that we continue to urge our members of Congress, and especially right now our senators, to get the Build Back Better Act passed as soon as possible. So it's important for advocates like yourselves to continue to pressure your senators and representatives to make sure this passes as quickly as possible. And you can do that by making phone calls, by going to town halls, by sending emails, whatever you feel most comfortable with. Feel free to engage in that type of advocacy. And then just as like a little preface, right now we are focusing on the Build Back Better Act, but we will be focusing more towards appropriations leading into the new year, and as we hear more about the continued resolution And we do know that the House of Representatives passed a continuing resolution next year up until early February, which will fund the federal government through that time. And there are some Republican members that are pushing for a full year continuing resolution, but this will be really harmful to the funding of housing programs in HUD. We want to make sure that that doesn't happen. So just be aware that we're probably going to be making that shift after the Build Back Better Act passes. Cool. Again, if you have any questions about that update, feel free to email Kim Johnson at kjohnson@nlihc.org. And now for the emergency rental assistance update. So last week to the day on November 29th, the Department of Treasury released data through October 31st. And so this revealed that an additional $2.2 billion in ERA1 and $666 million in ERA2 funding was spent in October. So overall, $13.1 billion from ERA1 and ERA2 had been dispersed to households, reaching over 2.5 million renter households. So after steadily increases in monthly ERA1 spending since the program's start, October marked the first month in which ERA spending decreased, but despite that decrease, ERA2 spending more than tripled between September and October. This trend highlights the uneven performance of ERA programs. And while roughly 100 programs have spent most of their ERA1 allocation and are transitioning to ERA2, other ERA1 grantees continue to spend slowly, with approximately 95 of grantees spending less than 1/3 of their ERA1 allocation. To increase the pace of the fund distribution in jurisdictions with high needs, Treasury is moving additional funds to jurisdictions that have spent their funds quickly and have remaining lead. And so we do have the link to Treasury's October ERA data, so you can see that, but NLIHC also released a statement and analysis of the ERA data that came out last week if you want to learn more about that, and we'll post both of those links in the chat. And again, if you have any questions about ERA, feel free to ask Emma, and we also have me too here as well. I didn't see if Emma hopped on yet, but we have folks here that can answer your questions in the chat if you have any. So now I am really excited to introduce, I guess, like my co-introductory remark, folks who will be joining us. So we're joined by Deborah Thrope of the National Housing Law Project today, who will be providing some more context to you all about the Moving to Work demonstration program. And Deborah, you can take it away.
Awesome, thank you so much, Sid. So as Sid said, my name is Deborah Thrope and I'm with the National Housing Law Project. And what I'm going to do now is just take a few minutes to kind of set the stage, on MTW, talk a little bit about the program's expansion, and then, why we are all here today. I know the main event is hearing from our consumer law experts. So I'm not going to take up too much time. I just want to sort of set a framework for what we're going to discuss. So the first thing I'm going to talk about is the MTW program, the Moving to Work program. It's MTW for short. So MTW is a demonstration program with HUD, and it originally allowed 39 public housing authorities, or I usually say PHA for short, to waive the rules that normally apply to the public housing and voucher programs. And the goal of the program was to see what would happen if HUD sort of takes the usual restrictions off of housing authorities around things like how they spend their money and the types of different program requirements. So what would PHAs do if you kind of lift those restrictions? So housing authorities since the beginning of the program implemented a wide range of policies and programs with their MTW flexibility. So a couple of examples. One is requiring less tenant recertifications, and maybe providing new services to tenants. So those are on the end of policies that advocates and tenants really like to see in the MTW program. And then sort of on the other end, we have things like work requirements and time limits, which some housing authorities have implemented, which tenants and advocates generally didn't approve of. So there's been a real range in the MTW program with respect to what housing authorities have done with this new flexibility. And then a few years ago, Congress expanded beyond the original 39 agencies to 100 more participating housing authorities. So now we have a total of about 139 agencies participating in this MTW program across the country. And you can find out whether you are in an MTW jurisdiction, and that way your housing authority is part of this MTW demonstration. And you can do that on HUD's website. And HUD has a really good MTW website. And I know what you're all thinking, Deborah, most of HUD's website is not great, and it can be very hard to navigate, with the exception of the MTW part of HUD's website. I will say they did a really good job making it very clear, not only which housing authorities are participating in the program, but whether they were one of the original 39 housing authorities or whether they're part of the expansion. And if they are part of the expansion, the website also tells you which research study they're participating in. So the expansion looked really different than the program for the original 39 agencies. Agencies now apply to be part of a specific research cohort. And there'll be likely 4 research cohorts in total. And not only that, but Congress also, with the expansion, basically required participation from different sized agencies. And they did that because they didn't want to just test new policies at really large agencies, for example, that might be better resourced than some of the smaller agencies. So they said you have to have some big, small, and medium housing authorities involved in the expansion. HUD chooses the different research cohorts that are part of the expansion. And they do that with the help of a panel of stakeholders. And the stakeholders are mostly research experts, although there are also other stakeholders like housing authorities and tenants as part of that panel. So HUD chose the following 4 cohorts as to be part of this expansion. So basically they're going to study the following things. So the first one is something called MTW flexibility, which basically says we're going to look at what happens when you provide all of this flexibility to a housing authority. Let's see what they come up with, and we're going to kind of study that and see what happens. Ideally see how it impacts tenants, see how it impacts the housing authorities, bottom line, et cetera. So the second cohort they're studying is rent reform, and that basically means they're just looking at different ways that you can calculate rent. Right now, of course, the rent is calculated 30% of income, and so they're going to be studying rent reform, different ways of doing that. The third one is landlord incentives in the voucher program, and the fourth one initially was a work requirement, but some of you probably advocated to switch that cohort into and basically eliminate it because, during a global pandemic and possible economic downturn, not the best time to do a cohort on work requirements for residents. So that's what we're here to talk about today. What are we going to study in the 4th cohort? And this is really important, not just if you're in an MTW jurisdiction, but it's really important for everybody because any policy or program that they take as part of the expansion, if it's successful, or in HUD's eyes, if it's successful, it's something that could be implemented nationwide. So these studies have huge implications for HUD tenants, again, not just in MTW jurisdictions. So we're really excited to talk to all of you today. The experts are going to kind of give you some different ideas, and we will be providing recommendations along with the coalition and a couple of other national organizations. And we really thought, it's important, of course, to hear about the needs around asset building from all of you, because that's arisen as one potential cohort. And so really important to kind of hear about what you all are interested in. So with that, I will turn it back to Sid. Thank you so much. And I'm looking forward to listening to everybody present. Thanks.
Thank you so much, Deborah. So now I'll move on to introducing our credit and asset building experts. So beginning with Sarah Shavin, co-executive Officer of Working Credit NFP. She'll be delivering a short presentation, and I'll be putting that up right now. But again, as a reminder, feel free to drop your questions in the Q&A box. And yeah, Sarah, I'll go ahead and put up your PowerPoint right now, and you can go ahead and get started.
Great, thank you. Hi, everyone. Like Sydney said, I'm Sarah, and it's really a pleasure to join this Tenant Talk with you. And thank you so much to Sydney and the team at NLIHC, kind of a mouthful there, for inviting me to participate with this great group of other presenters and folks. So I'm going to just sort of lay the groundwork for why credit building is such an important strategy for economic mobility and for asset building in particular. I work for a national nonprofit called Working Credit. And at Working Credit, we provide specifically credit building education, counseling, coaching, and access to safe, affordable products that help people thrive financially. But I wanted to start this conversation with a quick question for all of you. Knowing that credit is complicated and depending on your experience with it, feelings about credit can be positive and they can be negative and really negative. But if you would, maybe just take 30 seconds to chat in the chat box your thoughts on these questions. So what words come to mind when you think about credit, and what are some of your experiences with it? Would love to just hear some thoughts. Now I'll start my timer. Interest rates for credit cards were much lower before. Charge card is another thought that comes to mind when folks think about credit. Anyone have any kind of immediate sort of emotional reaction to credit? Not bad, but maybe, or no credit is maybe bad. That's a thank you, Mike, for that. That sets up our sets up our conversation well. Bad bills, yeah, very difficult for low-income seniors to get low interest rates. Credit is gray. Thanks, Serena. Yeah. Default judgments, difficult to understand. Or 30 seconds. But these are all really, really great thoughts. I'm going to go ahead and move on, Sydney, to the next slide, if you would, just for the sake of time. But it's really clear from these great responses that there's a real range of experiences and perceptions of credit. And the thing that we always start with at Working Credit is to acknowledge and validate the real challenges and sometimes the scariness, sometimes shame, sometimes frustration or outright anger around credit and the credit system that people experience, especially those who have been systematically excluded from it or set up in some cases to actually fail with it. But we also acknowledge the reality that in our economy, having good credit is really important to being able to get and stay ahead, and certainly important to being able to create wealth, now and for future generations. So along with our colleagues at Credit Builders Alliance, and you're going to hear next from Talia, who works at Credit Builders Alliance, one of the things that we try to do at Working Credit is shift our thinking about credit as a deficit to overcome to thinking about it as an asset to build. So an actual building block in the asset building, along the asset building spectrum. And this means that instead of only focusing on the ways that debt, which we distinguish as different from credit, can be or has been a barrier in our lives, we focus on how improving credit might open up new opportunities for the future and help us achieve our financial goals. One thing we know is true about whether you have no credit or whether you don't have good credit now is that credit scores are very elastic, and so there's always something that you can do to improve your credit. Next slide, please, Sid. So what does that do for us when credit is improved? Some of this is pretty obvious, but I think it's important to call out kind of how ubiquitous, how much credit permeates our lives in so many different ways. In addition to getting access to better quality financial products like loans and credit cards, a good credit score is going to help you pay less for those products. And I think we don't often in our field, we don't often talk enough about the connection between having a good credit score and being able to save real dollars. For example, going from just a 580 to a 710, in some cases can save you over $3,000 a year on different types of expenses, which is the equivalent of $1.50 an hour raise. And good credit can also help you save money by eliminating or reducing security deposits that you might need to put down to turn on utilities or get a cell phone contract, as well as in many states, car and homeowners insurance premiums. In almost all states, I think, except 3, which might be, Talia may know this better than I do, but Massachusetts, I think California and Hawaii, what you pay for your car insurance premium depends more on your credit score than on your driving record. So it's clearly an impactful thing to have a good credit score. And most of us require access to credit just to weather economic shocks, such as an unexpected job loss, a car that breaks down, sometimes just to smooth our income and expense fluctuations or misalignments throughout the month. So without access to credit, many people depend on predatory lenders to manage those situations and avert emergencies, which, as we all know, can turn into even greater problems down the road. And since many landlords and employers check credit histories, good credit can make the difference of getting a place to live or a job of our choice. And lastly, on this slide, a good credit history is, like I said earlier, an essential step for building assets, like starting a small business or buying a home. And many of you probably already know this, but with some exceptions, you have to have a credit score of 620 to qualify for a mortgage. Next slide, please, Sid. And while credit can be complex and every situation is individual, I also noted earlier that it's always possible to increase your score. So these are some of the foundational strategies for anyone who wants to establish, improve, or maintain good credit. First, you have to have at least one credit product that is open and in use, with payments being made at least once every 6 months, if not more. And those payments need to be being reported to the credit bureaus. This can be a credit card, an installment loan, or you're going to hear from Talia next. There are some new opportunities and strategies like having your rent reported. And then second, if the credit product you're using is a revolving product like a credit card, you have to keep those balances low. It's best, most people know sort of the 30% rule. It's best to stay below 30% of the limit on each and all of your cards, but the lower the better. So for example, if you have a credit limit of $600, try to keep that outstanding balance on your cards at or below $200 at any time. And then finally, make sure you pay your bills on time each month or whenever they are due, or at least within 30 days of the due date. This is critical because payment history is the #1 driver of the credit score algorithm. So if the payment isn't made within that 30 days of the due date, your score is going to go down. And you might also have to pay additional fees for late payments. So just to give you a sense really quickly of how at Working Credit we see these basic strategies or rules help our participants. Along with the one-on-one counseling and coaching we offer them in dealing with other financial issues. We see people who come to us with no score, often able, very, very often actually, able to establish a prime credit score within 6 months. And for those who come to us with existing scores but low scores, we often see them improving their scores by an average of about 30 points within 12 months. Of course, the key thing there is we want to see them not just improve the number of points, but we want to see them move from a higher risk tier like subprime to a lower risk tier like prime, so that they can actually access better rates and products and services. So I know that was a lot of information thrown at you fast, but for the sake of time, I'm happy to answer any questions now or later as time allows.
Thank you so much, Sarah. I think we had 2 questions in the chat. And the first one that we have is from Theodore. Why don't the Housing Authority advocate for more money for the home buying program? I think it's referring to the PHA home ownership program. Theodore lives in Los Angeles and they suspended the home buying program. And then Theodore also followed up with, is it a good idea to pay off your credit cards if you have the money, or should you save the money?
Great. Well, so I can't really speak to the first question, unfortunately, but to the second question, it can be good to pay off your credit cards, not only because you don't want to be paying the interest on those credit cards if you don't have to, but again, the lower the balance you have, which 0 is the lowest you can go on those credit cards, the better that'll be for your credit score, generally speaking.
Sounds good. Thank you for sharing that. So for the sake of time, I'll be saving some of the questions and going over some comments at the end as well. But now I'll be introducing Talia Kahn-Kravis from the Credit Builders Alliance. And I'll let you take it away, and I'll put up your screen or your PowerPoint in just a second.
Great, thank you. Thanks so much for having me here. And my name's Talia. I'm from the Credit Builders Alliance. We're a national organization that helps organizations and affordable housing providers and a whole bunch of other nonprofit and public entities help people build credit. And so I'm just going to build off of what Sarah was saying and talk a little bit more about specific strategies that you can use to build credit. So you can go to the second slide there. So I just wanted to start off by sharing just some examples of credit building products. And I'm seeing some really interesting comments and questions in the chat. So it sounds like you all are already thinking about different types of products, but we are seeing, across the country, since affordable housing providers are some of our members, we're seeing increased interest in supporting their residents to build credit as a way to transition to homeownership or achieve their other goals. And some example products that people use to build their credit are things, the starter product category can include secured cards where you're paying a small amount and then that's the limit on your card. And often if you're not able to get credit, this is kind of a low risk way to get into a longer term credit card. Another type of product that we see are credit builder loans. And these function similarly to a secured credit card, but you're basically taking out a loan and not getting any money up front, and you're paying each month as if you're saving money to an account, but that helps you build credit. Just a few other ones that I'm really going to spend the most time talking about rent reporting, and I saw a question about that in the chat. Social loans, so these are like, if you've heard of lending circles where people are putting money in a pot each month, or a proverbial pot, and one person gets the chance to pull out the money. And this is something that's just traditional to many cultures around the world. And so organizations have figured out how to make them credit building and kind of formalize the process. Special purpose loans, we've seen a bunch of loans related to housing stability. So loans for paying for security deposits, stuff like that, and small business loans. And so you can go to the next slide. I'm going to talk mostly about how rent reporting, because we see this as a strategy that it just makes a lot of sense for public housing authorities to pilot. And we worked with public housing authorities to do this and seen positive results. So what is rent reporting? It's very basic. It's the reporting of rental payments to at least one major credit bureau. So it shows up on a tenant's report. And you can go to the next slide. And so typically renters not had the chance to have their rent reported to the bureaus. And I saw someone mention that, sometimes your utilities go to your credit report if they're late. Same with your rent. Sometimes, in some cases, your landlords aren't typically reporting rent to the credit bureaus, but it shows up if you have a major delinquency in your rent. And so rent reporting kind of flips the switch, and you're getting credit for positive rental payments. So it's an opportunity to get credit for something that you're already doing. Helps you build credit without having to take on additional debt, and is just very low risk and can help you work towards other financial goals. Next slide. And so actually Sarah, who spoke before me, was involved in this pilot about 6 years ago now. And since then, there's been a bunch more studies that have shown the power of rent reporting. But when we first did this pilot, we worked with about 8 housing authorities or affordable housing providers, and enrolled about 1,000 residents in the program. And of those surveyed before the program, 97% said that rent reporting seemed like a good way that they would build credit. Of those that had a credit score when they started the pilot, 79% experienced an increase in their score by an average of 23 points. And the increase was larger for residents with really low scores. The increase was about 32 points. And then we saw with people that didn't have enough experience with credit, so they didn't have a score. So maybe they only had 1 or 2 lines of credit. And so they weren't scored 100%, became scored. You can go to the next slide. And so I'll just quickly, how does it work? Basically, the landlord needs to set up with a way to report rent to the credit bureaus, either through a third party or they're doing it directly. And then they do outreach on the ground to get residents to sign up. So at a public housing authority, it's an opt-in program. So residents are actively deciding if this makes sense for them. And then once residents enroll, they can disenroll at any time. But while they're participating, their rents show up on their credit report, and they'll hopefully see positive impact on their credit over time. Next slide. And so this is just a quick example. We've worked with the District of Columbia Housing Authority, the Housing Authority of Portland, Oregon, and we know that the Housing Authority of Pittsburgh is also offering rent reporting. And so these are all moving to work, early adopters of rent reporting who have seen positive results. There's just some quick, some challenges and opportunities related to rent reporting. One is just there's little awareness about it on the part of the housing providers and residents. And so, building the knowledge among tenants is really important so that they can advocate for it from their landlords. And another piece is that at first glance, it can seem a little complicated because you have to figure out how you're going to do the reporting. But since we did that pilot in 2015, the field has evolved a lot, and the ways to report have gotten a lot easier. There is typically, if you're going with a third party to do the reporting, the landlord, that would be the work that the landlord does, and the tenant doesn't have to deal with the third party, but there's typically a small cost associated with it. And then just another piece, going back to what Sarah was talking about, this is a really powerful strategy when it's paired with credit coaching. So if there's an organization like Rethink Credit or some resident service providers can help any tenants that are interested in this in reviewing their report, correcting any errors, then that really enhances the impact of rent reporting. And the last slide just has my contact and our website about rent reporting where you can go to learn more. So happy to answer any questions, and hope this has sparked your interest a little bit.
Thank you, Talia. I think we did have a few questions come in, actually. I'll go ahead and just have you answer one for right now, and we'll come back to the rest of them in a second, just to make sure that we get to Ariel. But let's see which one was the newest one. Theodore again asked one question: what is a good interest rate on a loan to consolidate your credit cards?
It's a good question, and Sarah, feel free to chime in. There's many, it kind of depends on how large the loan is and what the terms are. There's a movement to ensure that there's a 36% cap on any kind of interest rate. That would be very high for a credit card. I can't say exactly what a number. I don't know, Sarah, do you have a?
Yeah, I don't know that there is exactly a number, but definitely anything below 36%. I think the best bet, of course, this means you also have to have an active bank account, but your best bet for those kinds of loans would be if you have a credit union or a bank, to try to find a loan that way rather than through an online lender, which are sort of proliferating and can offer some decent products, but can be a little risky sometimes too.
Talia, I don't know if you had a last minute thought to add there.
No, yeah, but I am seeing a bunch of questions related to rent reporting that I could answer pretty quickly. One is, if I'm on a voucher, would 1/3 of my rent help me improve credit? Yeah, and that's something great about rent reporting, is that it doesn't matter how much you're paying for rent, that the amount that you're paying is what's reported to the credit bureaus. And then there's a question that says, are there any for-profit management companies using this? Yes, we've seen, so this is a strategy that's being offered not only in affordable housing, but market rate housing. And so we've seen both for-profit and nonprofit management companies offering it.
Awesome. Thank you so much again, Talia. I'm going to go ahead and move to our last presenter for today. Ariel Nelson is joining us today from the National Consumer Law Center. You can go ahead and take it away, Ariel.
Thanks, Sid, for having me, and to all of you for being here, and all my co-presenters. I just want to start out by saying that I'm an attorney at the National Consumer Law Center, and most of what I do is advocate for policy changes. And a lot of what my work entails is talking about the problems with credit reports and credit scores and the credit bureaus. So some of what I might have to say is sometimes a little less rosy, but we focus our work on advocating for low-income consumers. And thanks to Talia for the introduction to rent reporting. You know, part of what that idea is designed to do is get at the around 45 million consumers who are either credit invisible or have a thin file, which, like Talia says, means that they don't have any information at a credit bureau, or it's too sparse to generate a credit score. And we know that Black and Hispanic consumers are disproportionately represented in that group. And so there's been a lot of excitement around this idea of rent reporting. But one thing to note up front is that currently I've seen numbers only around 5% of renters have rent payments reported on their credit report. And that's partially because there aren't that many landlords who are engaging in this yet. And, you know, I think it's easier for bigger management companies or public housing authorities sometimes than smaller landlords to do this, because these entities would report this information to the credit bureaus. And you may be familiar with who the big three credit bureaus are. They're TransUnion, Equifax, and Experian. And we at the National Consumer Law Center think that rent reporting could be really promising for a lot of the reasons that Talia was saying, but we really think that everyone should proceed with caution, because what we really don't want to happen with rent reporting is for some folks to actually be hurt instead of helped, which the goal is, of course, for people to be helped, but we think that unless the programs are designed really carefully, that might not be what happens. And so just to kind of illustrate some of what we think are better and less good approaches to how you could do rental reporting, I want to talk a little bit about these two programs that have been implemented recently by Fannie Mae and Freddie Mac. And you may have heard of Fannie Mae and Freddie Mac before. They're large federally backed companies that guarantee most of the mortgages made in the United States. And Fannie Mae is now using rental payment data to underwrite mortgages. So they're thinking about it in this context of how do we try to get more people to be able to be homeowners? And what they're doing is using rental payment data only with the applicant's permission, which means, of course, that the consumer gets to decide. They are in control of whether to allow access to this data about rental reporting. And Fannie is doing it a little differently from the system that Talia described, which is that they are not going through the credit bureaus at all. They are using data from bank accounts and identifying automatically recurring rent payments in bank statements. And like I said, that means they're just going through your bank account, not through the credit bureaus. And Fannie Mae is saying that they're not going to use missed or inconsistent payments, and there's absolutely no way that this data can hurt an applicant's credit score. It will only be used to help the consumer. And so we think this approach is really good because it's opt-in. Only the consumer isn't having that information used if you don't want it used, and it's only the positive data. And then also they are not going through the credit bureaus, like I said, and I'll talk a little bit more about why I think that can be a really good thing in a second. And so that's Fannie Mae, one of these federally backed companies that I talked about. Then there's Freddie Mac, which also just started a rent reporting initiative. And they are doing kind of more what Talia described, which is they're automatically delivering, it entails the automatic delivery of on-time rental payment data from property management software programs to the credit bureaus. And like the Fannie Mae program, it's only positive information, on-time payments only. And they also say that a person will be automatically unenrolled from the program if renters miss payments, which means that the negative information won't be delivered to the credit bureaus. So we think that this has some good features to it. It's only the positive information. And like they're saying that you'll be automatically unenrolled if something goes wrong. But we think that it would be even better if it was only with the consumer's permission. And like I was alluding to before, it goes through the credit bureaus. And we think that this can be a problem because there are so many errors in credit reports as one factor. And it's hard to get them corrected sometimes. So, you know, these credit bureaus have these big databases of information and things go wrong. And so we kind of like this more direct way, which may not, you know, it might be hard to make it apply in a variety of contexts, but certainly in something like a mortgage lending situation could be a great moment for that. And the other thing I just want to mention about credit scores and reports, which is partially why we're concerned about them, is that they're just simply huge racial disparities in them. And so, you know, there's a lot of ground to make up there. And so just to recap real quick before I turn it back to Sid, our takeaways on best practices for rent reporting are: 1, consumer consent, opt-in only; 2, only use data that will help consumers. We're super concerned, you know, especially in the pandemic where no fault of their own, people couldn't pay rent. And then 3, if possible, don't go through the credit bureaus, find another way to use rent reporting information to help consumers. Thanks so much, Sid.
Awesome. Thank you so much, Ariel, and thank you to Sarah and Talia for also presenting for us today and providing their expertise on these topics. So really quickly, I'm just going to go over the last 2 questions that are in the Q&A box, and then if any folks want to come off mute and ask any questions, please feel free to raise your hand and offer some of your thoughts on some of the things that we heard today. So I don't know if anybody on the call today would have expertise on PHA homeownership, but Linda Soderstrom asked, I heard if PHAs allowed voucher holders to buy a home that the homeowner keeps the equity because HUD doesn't calculate it as theirs. Is that true? And if nobody has the answer to that question right now, I can follow up with you after, Linda. I think there's some folks from Chicago, Illinois too that work on PHA homeownership specifically that can probably have more details on that question. Okay, I'll go ahead and keep that one pinned for you, Linda. That way we can get back to you on that. Sarah, I don't know. I know you just, and then we also,
for the last question, I can take
the last. Okay, so the last question that we have in the Q&A right now says, why should people that take longer to pay off or pay things off be the only really reliable to move up a credit score? It seems you have to get behind to truly get ahead.
Yeah, I think the answer to this question, or the thing that I would mention is that for credit building strategies, like Talia mentioned, don't necessarily require people to go into debt. So, rent reporting, for example, people are already paying their rent payments, making the rent payments. If that rent can accurately, get into the system, then it can help people build credit without taking on any additional debt, or even like the risk of incurring additional debt. We talk about credit cards, certainly secured credit cards, which come with a whole host of risks for a lot of people, but for example, if you do have a credit card that's 0% interest, and let's say you just use it to to buy your gas once a month, or buy groceries once a month, and then you pay that back, you're effectively getting a 30-day loan at no interest, and you're not carrying any debt. So if I understand the question right, I think it is possible to build a credit history without getting behind. The challenge is, life happens often, and people do get behind, and so that's a real it's a balancing act for sure.
Most definitely. And Theodore is saying that he is a homeless advocate. How could I present this program to the company I work with? And it's with CHS, the Corporation for Supportive Housing.
I guess I can speak for everybody that we'd be happy to supply you with resources to present. So feel free to reach out to any of us. I think I'll put my contact in the chat as well.
Sounds great, thank you. And then I think this got asked twice somewhere, but I know that some folks are interested in learning more about how this is impacted by the Comprehensive Credit Act or the Protection or Protect Your Credit Score Act of 2021.
Talia and Ariel, I don't know if either of you have more information about it, but my understanding of this act is that essentially it is trying to ensure that there is both more accuracy, trying to require more accuracy within the system, and then make the system more transparent and consolidate it a little bit, and improve the dispute process, because one of the things that we see is that there are a lot of errors. Ariel mentioned this in her comments, a lot of errors on credit reports, and the system is not designed well to manage those errors. And so my understanding of this act is that it really is trying to make it easier for us as consumers to both understand where to go and how to access the information we need and deserve about our own credit history, and also manage that more easily through the system.
Thank you. So I have another question here that was from a while ago as well, but it says some cultural approaches do not allow for borrowing or interest. How do PHAs regard Islamic, I think it's strictures or structures against if helping families buy? But I know this, I think this one was from Linda Soderstrom. Whoever asked that question, if you'd like to elaborate more, feel free to raise your hand and I can give you the permission to talk live so you can elaborate on your thoughts a little bit more.
And I can give a quick answer because that's such a great question. And so we know that, some interpretations of Sharia law say that you can't have an interest-bearing product, and so rent reporting is kind of a way around that because there's no interest attached to it. I think there's other types of products out there that are zero interest, and like lending circles, a strategy that I mentioned earlier, where people are saving money with each other and everybody has the opportunity to get money out of the whole pot. So I think there's a number of different strategies to help people build credit and still be compliant with with their religious laws.
That's really interesting. I actually didn't know that. So that's like good context to know too on a cultural level. I just saw a really good question too come in from David Weber. He asked, while I agree that HUD should pursue and study this, rent reporting and credit improvement strategies do not require any statutory or regulatory modifications to public housing regulations. So why do this through the Moving to Work program or demonstration?
Do you want me to take this one? So very good question. And we did talk about this before the Tenant Talk Live. So asset building has sort of risen to the top of HUD's list for this final cohort. And it could look a lot of different ways. So I think when they say asset building, there's a lot that goes under that umbrella. And so we kind of wanted to talk to the experts here from Tenant, all of you on the call, kind of what pie in the sky, what you all would like to see with respect to innovative credit building programs, home ownership building programs. It could really look a lot of different ways. So it's true that some of this housing authorities could do tomorrow. They don't need any MTW flexibility, but we're trying to kind of hear from tenants what their priorities are, and then maybe think outside the box a little bit. Maybe there's aspects of these programs that are really innovative that might apply at a housing authority, and they might need the regulatory flexibility to do it. So it's a good question, and we're trying to kind of put the MTW logistics aside and hear from folks about what their needs are with respect to asset building.
Thank you, Deborah. So I know there's still some questions and we're running low on time right now, but I just want to remind everyone, if you ever have any feedback that you would want to provide additionally to what was said in the chat today, please feel free to email me those like credit building strategies or any innovative ideas like Deborah just said. And I can share them with folks so that your input does get included in this new cohort that will hopefully begin soon. So yeah, does anybody, any of the attendees today just want to give like a last minute thought or a last minute question before I close this off today? And thank our speakers for being here today. We have CJ saying in the chat, it's a real shame paying a car loan 6 months early can actually hurt your credit score. And then Talisa, I think this was in response to Talia's answer, but it's just talking about needing a partnership with the Attorney General. And then David Weber saying that this is helpful and looking forward to future conversations on homeownership, asset building, and moving to work, etc. And then, yes, I do save the chat, and I'll share that with everybody too. I know it was like a very jam-packed session today, and there was a lot of information thrown at you folks, but the goal here really is to continue the conversation and continue to improve these programs. Ideally with this feedback, we can improve the program for future cohorts as well. And I know Ariel is dropping a lot of useful links in the chat. I'll make sure to share that chat with you all in the follow-up email for you all. But again, I just want to thank all our presenters today, Sarah, Talia, and Ariel for joining us today, for all the attendees that are here today, and again to Deborah for helping us kind of learn more about the MTW demonstration. If you have any questions or if you have any suggestions for future Tenant Talk Lives, you can always email me at sbetancourt@nlihc.org. But besides that, I hope you all have a great night, everybody, and I look forward to seeing you next month. I might be on vacation, I might not, we're still trying to figure that out, but if I don't see you in January, I'll see you in February. Have a good night, everybody. Bye, and happy holidays.